Hi, I'm Campbell Harvey, and I'm a professor of finance at the Fuqua School of Business. And today what I'd like to do is to talk about gold. Gold is in the news. It's near an all-time high. And in addition, there is a lot of talk about investing in gold at this particular time. So, for example, a major pension plan has got a new 5% allocation to gold. Indeed, they said that they were going to borrow the money to invest in the gold. So what about gold? And this has been a topic on my research, and indeed, I invite you to download some of these papers that I've written, but I've got a new one. So let me talk about the idea of why would we invest in gold? And there are basically two reasons. One is it's a so-called safe haven, and the other is that it's a hedge against unexpected inflation. So let's talk about inflation first. And in my 2013 paper, we had a very interesting example, and that is going back 2,000 years to ancient Rome. And the Romans kept great records. And we actually know how much the soldiers were paid. And indeed, we've got the coins, so we can actually figure out the gold content of the coins. And we determined that a Roman centurion was paid 38 ounces of gold. That's kind of interesting, because what we can do is to look at that 38 ounces and translate it into today's dollars based upon the market price. And when you do that, the wage of the Roman centurion is roughly the wage of a US Army captain. So what does that mean? It means that gold holds its value over the very long term. It doesn't appreciate in real value. It might appreciate in nominal value with inflation, but its real value is relatively constant. We went even further back in time to the time of Nebuchadnezzar and determined the price of a loaf of bread in gold. And today's price would be about $5.50, which is not that far away from what you would pay at your local boutique bakery for a fine loaf of bread. So gold does provide an inflation hedge over the very long term. The problem is the shorter term. So what I'd like to do right now is to share some slides and to kind of go through my thinking on this. And these slides are from my recent paper. And this is the modern history of gold. Modern history is from 1975, and that's when gold was traded on futures exchanges. Many people don't realize that it was illegal to hold gold. There was a long period where you could not hold gold that began in the Great Depression by an executive decree. So this is the modern period, and you can see the gold is sometimes above the average line, and the average line is basically indicating a real price of gold, so gold divided by the inflation level, that's constant. And we call this the golden constant, and it's the same argument about the Roman soldiers. So the same idea that over the long term, the real return is zero, which means that gold holds its value in real terms. So you can see sometimes you're above, sometimes you're below. And notice what happens at the previous peaks. So we're very close to the previous peaks in terms of real gold prices. So in January 1980, it didn't turn out well for investors. So over the next 5 years, gold dropped by 55%. And in August 2011, it didn't turn out well for investors either. Over the next 5 years, gold dropped by 28%. And you can see where we are today. So it turns out that, and this is confusing to some, but hopefully not to you, I said that gold was a reliable hedge for inflation over the very long term. And the long term I was talking about was 2,000 years. What about the shorter term? And this is a very powerful slide. It shows the gold price, both the nominal and the real gold price, versus inflation measured over 5-year periods. And notice that the volatility of inflation is really low. So the volatility of inflation over the last 20 years is something like 1% per year. Gold is like the S&P 500, 15% per year. So basically, gold is just too volatile to provide an inflation hedge that's reliable. And you can see from this graph that there are decades where gold underperforms inflation, and there are decades where gold does better than inflation. And that's what I mean by unreliable. So what about the gold price today? Why is it so high? Why are we at this very elevated level? So one possibility is that people expect some surge in inflation, but we certainly don't see that in the bond market. So the bond yields are very low, and the break-even inflation that we can back out of the inflation-protected bonds is about 1.7% right now over the next 10 years. So the inflation expectation really can't explain why the gold price is so high. So there's another story that people like to tell, and there is a negative relation between the gold price and treasury yields. Okay, and this gets a lot of play, and I'm showing you that there appears to be a strong correlation between the gold price and the real yields. The problem with this graph is, well, there are many problems with it. One problem is that these two variables, gold prices and yields, are what we call in economics endogenous variables. And what that means is that they're likely caused by other factors. And what we're seeing is a correlation that seems very strong, yet there's not a lot of economic foundation for it. And it might be an example of a spurious correlation. And I've seen this graph, and indeed yesterday in the Wall Street Journal, something like this was presented, and they were talking about the relation between real yields and gold prices. And basically the idea here, as the yields go lower, the gold price goes higher, and it's definitely evident in the data. It's highly significant. So is it real? Well, what about a different sample? And you can see that it depends on the sample that you pick. So there's a negative relation, there's a strong positive relation, and then there's no relation. So I would be very, very careful about this and drawing inference on just because the real yields are low, that means the gold price is going higher. And importantly, this is really important, that if you believe that those rates are going to go up, well, even if this relation holds, if it doesn't break down, that means the gold price will drop. So here is kind of the most important graph that is featured in my paper. And this time is different. It's certainly different than 1980 because it's now possible for retail investors to actually hold gold. So you can always hold gold by buying coins or bullion, but it's really expensive to buy those coins. So you're buying not at a very good price per troy ounce. And bullion is difficult to buy, it's difficult to sell, it's difficult to house. But there was this great idea of creating an ETF based upon gold. So what I graphed here is the ETFs, the top two ETFs, and GLD is the most well-known. And I graphed the holdings in millions of troy ounces against the real gold price. Now, this is a graph that doesn't suffer from the same problem that we saw previously. And this is a very strong fit. So in finance, we rarely see anything like this. And this is very strong. So what does it mean? Well, it means that the retail investors are holding gold. That's definitely the case. But it also means something else. And it means that essentially the retail investors are buying more as the gold price is going up. So I would like to remind you of this famous Warren Buffett quote. And it has to do with bandwagon investors. And what Buffett said was, as bandwagon investors join the party, they create their own truth for a while. So let's unpack that. So people are investing in gold, the price is going up. Others see the price going up and they join the party. And as they join the party, they buy more gold. So if you buy this ETF, the ETF needs to go out and buy the actual physical bullion and store it. So when that happens, this additional buying, the price goes up even more. So this is the idea of basically validating your investment thesis. So as more and more people are buying, it's going up for a while. Eventually, the party ends. You don't see as many people coming in, the price flattens out. Then some people say, well, maybe this is a good time to profit take. And then you sell. Okay, so this is obviously a considerable risk for investors. So to me, gold is a risk asset. So let's go back to March in the worst month of the global financial crisis. So in March, the stock market plunged. Interestingly, gold also dropped in value. And the so-called new gold, Bitcoin, dropped by over 50% in March. So what do I think of that? This is what I think, that these are just risk assets. And when you're in an environment where you need to go and reduce your risk, what do? Well, you dump your stocks, you dump your gold, and you dump your Bitcoin. And then you go into cash or government bonds, something that you consider safe. And then what happens? In April, mid-April, beginning of May, investors' attitudes turn around, the stock market starts to increase, people enter the market, it's a risk-on environment rather than risk-off. So initially people were taking risk off in March, now they're putting risk on. So what happens? The stock market goes to near an all-time high. Bitcoin goes up by 100%, and gold rallies to a near all-time high. So this is just a risk asset. And you need to be really careful with risk assets, especially when they're near all-time highs. So this pension plan that allocated 5%, I'm not going to name the pension plan, but they were actually advised by an advisor that is likely talking to other pension plans. And again, given that we've got a long history of gold, so gold is not Bitcoin. Bitcoin, we've got 10 years of data. Gold, we've got 3,000 years of data. So it's not new, but it's just so poorly understood. Okay, so to allocate 5%, thinking that this will provide some sort of inflation hedge, no. There's other ways to get inflation protection that are much more efficient than gold. Gold is unreliable. And as for a hedge in a crisis, well, we saw evidence of that in March 2020 that I just went through. When there's a crisis, we're in risk off. And did gold provide a hedge? No. It dropped just like the stock market. indeed about the same amount. Okay, so again, we need to be careful about gold, and I see a lot of questions have come in, and what I'd like to do now is to go to these questions. And okay. Oh, this is a good one. Didn't Warren Buffett just buy gold? So it seems to contradict what I just said. And it's true that he bought gold, but gold in capital letters. And that is actually him buying Barrick, a gold mining firm. And it's not, if he wanted to be long gold, he could easily do that. He could buy the ETF, he could buy the bullion, given he's so large. But this is essentially Warren Buffett seeing a value play and buying Barrick. So that was widely misreported in the media. Okay, let me continue to take a look here. Okay, this is from Rod, a Fuqua alum. What about gold as a fiat currency, a hyperinflation hedge? Okay, so that is a great question, Rod. And my 2013 paper, what we do is we detailed 55 historic hyperinflations. And we know some of them, right? The hyperinflation in the Weimar Republic and things like that. And then what we did is we looked at the price of gold during those hyperinflations. So for example, we highlighted the one we picked. We didn't pick the Weimar Republic, but we picked the Brazil hyperinflation. And during that hyperinflation, it was devastating for holding the Brazilian currency. But if you're just long gold, you lost 50%. So it wasn't a hedge. And if you go through these hyperinflations, again, gold is unreliable. Okay. So the other part of your question is kind of related, and this has to do with fiat currency itself. So we are in the age of fiat currency. There's nothing backing our currencies. Indeed, the last currency to go off gold was the Swiss franc. So there's no collateralization anymore for any of our currencies. So in a way, they are bubbles in that they have value because people believe that they have value. However, and this is very important, gold does have intrinsic value. So 70% of gold production is actually used for jewelry. So it does have some value. You could argue that the cryptocurrencies don't have any fundamental value. So they're more like a fiat in that they've got value only because people believe they got value. But gold actually has some value. And I want to make something clear that might not be clear. And that is, I'm critical of the pension plan borrowing to invest 5% in gold, thinking that they'll get an inflation hedge. But I actually don't have any problem with you having gold in your portfolio. A diversified portfolio should include real assets. And real assets are things like gold, real estate. There are many alternatives that should go into your portfolio. It's just not a matter of stocks and bonds. I've got another question from Shri about silver. So silver is another precious metal, and we have seen wild deviations. Many people tried to play the spread between gold and silver. It's a classic pairs trade. We have seen what happened with silver with the Hunt brothers, where what did they do? Well, they're trying to corner the market and they're buying the silver all the way up. until it dropped. And they got squeezed and wiped out as a result. It is just another example of buying as the price goes up. Some people call this momentum, and let me make a brief comment on that. So buying as the price goes up is sometimes called a trend following strategy. However, and this is very important because in terms of my outside work, I'm very much involved in strategies like this. And it is possible that trend following investors can drive prices beyond fundamentals, so that buying pressure leads the price to go above fundamental value. And when it does, it turns out that these trend following strategies tend to de-risk. So it's a bit paradoxical that when you've got your strongest buy signal, you actually take off risk. Okay, so that's very common in these strategies. So again, it might be that these strategies are contributing to the price going up, but at some point they start to de-risk, and that means they sell. And as they sell, the prices usually go down. So that is a good question. And indeed, some of the relation between gold and silver is linked to all the people doing this trade. Then I've got a question from Vikas. When do you expect in the future gold loses its value and is going to be replaced by cryptos? Well, you need to take my course, or if you're an alum, I've got a Coursera called Blockchain Business Models. The first thing when you say cryptos, well, what do we mean? We've got cryptos that are collateralized, and we've got cryptos that are collateralized by gold. So you can actually buy a token that, unlike the ETF, you could easily buy a token that's worth like $1 of gold and put that in your wallet. So I don't think the gold is going away. I do think it'll be easier to actually hold it. And as for people saying, well, Bitcoin or cryptos are the new safe haven, again, I point to the observation in March. And indeed, before that, I'm on the record saying, well, how can you say that Bitcoin's a safe haven when we only have 10 years of history? It's never even been through a recession. Well, what happens in the first recession? In March, it drops by 50%. Okay, so that's no safe haven. So cryptos will replace a number of things. So they will replace the ETFs, they'll replace stocks, and it'll just be a different way of actually holding. So in the stock market, this is extraordinary. I know you think you can trade quickly, but to take ownership of a stock in the US, to transfer the ownership takes 2 days. That doesn't make any sense. 2 days. And there's all sorts of fees involved. So cryptos will play an important role. So I've got a question from Sam, an alum. Is gold going to potentially correct plus or minus 10% in the next year, especially after elections? Look, the volatility of gold is 15%. That's the standard deviation, 15%. So think of a 95% confidence interval, which would be 2 standard deviations. So not unusual to go plus or minus 30%. That wouldn't be unusual. Okay, so 10% is no big deal. So the one thing, remember I said that gold can deviate from its fundamental value, which I take as a constant real price. So it can deviate. But the question is, when does it revert? There's no theory for that. And given the long history, remember I said that gold could underperform inflation for decades. Okay, so we're not in a position to basically give investment advice saying, well, gold will revert in the next few months. No, we can make a statement based upon a simple model that gold seems expensive. And indeed, gold's not the only thing that's expensive. The stock market's expensive and the bonds are expensive. So the rates are so low, that means the prices are very high. So I think all of these things are linked. The stock market, the bond market, and golds in terms of this is the time for speculation, and the speculation has driven the price very high. So 10% plus or minus, that's kind of a blink of the eye in terms of the volatility. Okay, question from Robert. Why did the pension decide to borrow instead of investing in gold directly? Well, they did invest directly, they just borrowed. So I guess the alternative was to sell some assets, right? So it could be that they don't have enough cash to do that. They get some leverage from doing this. But essentially, this is a situation where they are buying high. There's no doubt about it. Okay, so what do I think? This is a question that doesn't have a name associated with it. What do I think of stable coins one-to-one to US dollars? Okay, so we're kind of morphing into a crypto situation. A stable coin is something that I just described with respect to gold. So a stable coin is a collateralized cryptocurrency. So I described gold, and that would be a crypto token that is backed by physical gold. So it's housed somewhere. You can also have stable coins that are collateralized by US dollars. It is difficult to have a stable coin that's uncollateralized. Nobody's really figured that out yet. There's always collateralization. I'm actually very interested in these stable coins, and they play a very important role in the course. Now I see it's Angel, a Fuqua alum, asking the question. So these stable coins are exactly what I described, a collateralized coin that could represent gold, they could represent bonds, they could represent stocks, they could represent many different things. So I think that there is a lot of possibilities here. And I've got a new paper that's not quite released yet, but I'll make it available on SSRN fairly soon on decentralized finance or DeFi. And we spent a lot of time in this paper going through how DeFi will fundamentally change the world of finance. And indeed, this idea of decentralization is really interesting in that, call it full circle. And what I mean by that is go back to ancient times. It was decentralized. It's called the barter system. So if you wanted a goat, and you only had a peg, you had to find somebody with that goat that wanted the peg. So the matching problem was so challenging. And then we had some sort of currency, initially stones and shells, then a specie currency like gold, and now we're in the fiat currency. But what we talk about in the paper is that now with blockchain technology, internet, we can actually return to the barter system. So that's interesting. I've got time only for one more quick question. And this is a question on perpetual bonds. And look, I'm very much in favor of John Cochrane's idea. And I've been active on this front also. If you've got a government debt like the US has, you need to be issuing the longest possible maturity bonds. And there should be only 2 bonds that are issued. Forget these on the run, off the run bonds. There should be a perpetual bond that's got no maturity. And there should be another perpetual bond that is a floating rate bond. So that essentially is like a 30-day treasury bill. And we're done. And most of the financing should come from the longer term bond. So when you've got rates this low, you need to lock in for the longer term. And it's especially important because effectively you control the inflation rate. So the people issuing the bonds effectively control the inflation rate. So there's many more questions here. Follow me on LinkedIn, message me, and maybe I can address more of these questions. I need to sign off now, but next week we've got Kim, who is going to discuss intergenerational decisions. There's a nice linkage between what she's going to talk about and my gold experience. And that I did talk to investors that had a huge long gold position. And I told them about my paper. And they said, yeah, we read your paper. And I said, well, how can you hold this gold as an inflation hedge? Well, it's because we're an intergenerational family office. And what we consider the long term is centuries. And we know your paper, and that's why we're long gold. So I'll sign off now, and I'll look forward to your questions.